Hey there, welcome to the My Risk Advisor podcast. This podcast is for anyone in the financial planning ecosystem with a focus on life risk insurance. I'm your host, Phil Thompson, Director and Financial Advisor at Sky Wealth, and I've been on a business journey over the last few years going from a struggling holistic advice firm with one staff member, considering packing it all in, to pivot the business now to being one of Australia's leading specialist insurance advice firms with over 7 advisors, 30 team members, and helping hundreds of clients every single year get important insurance cover in place. I am unashamed to say that this podcast is so I can continue to grow and develop as an advisor and a business owner as I interview some incredibly smart individuals. So keep on listening so you can learn alongside me. All right, awesome. Today with me, I've got Peter Stathis, the life insurance guy. So thanks for joining me today, Peter.
It's a pleasure, Phil. Good to be here.
So I just want to start off the conversation just to get a bit of an understanding about your journey in and around advice and what have you done and what are you doing today?
Oh, gosh. Look, let me try and keep it as brief as I can. But I left uni and took on a banking career and just didn't like it. My entry into financial protection was about 20 years ago. A fellow who is still in the industry, but in the para services that support industry, called Jack Siegler, came in to speak to some of my contemporaries about business financial protection. And he was a really impressive guy and really got me thinking that, hey, maybe I'm not so interested in superannuation, and I am more concerned about how people plan in the event of. I can honestly tell you that my proper journey into life insurance didn't begin with AMP, even though that's where it properly germinated. It probably began when someone said, I think you'd be a really good business development manager, and a group called AIG decided to hire me as I think they called them sales managers back then, which looked pretty cool on a business card. And my hair was a lot darker. And I thought, this is a great caper. Yeah, straight off, I realized that, this is what I needed to do all along. Help financial planners realize their clients' financial protection needs.
And so you went in the product side of the business. Was there anything throughout your journey that you thought, I'd go into the advisor journey?
Look, in my early days, working my way through the alphabet, starting in a bank that began with A and then moving on to a superannuation insurance business that began with A, it never got to Z. So I'll get there eventually, I imagine. But believe it or not, the last advice document I signed was actually called a customer advice record. So yes, I sat on that side, and it was from that side that someone said, hey, you know what, we think you do well in distribution.
I know of customer advice records, but I was well before my time as well. So I reckon most of the listeners wouldn't even know what they are.
No. And your listeners would be rolling over laughing to find out that your authority was actually had a heading on it from ASIC. Your authority from ASIC said dealer's license.
Yeah, I mean, look, history does repeat itself, so we may get back there. The way things are going, so we'll see. But so you've kind of come out of the product space, and now you start in the life insurance guy. So help me understand, what was the motivation, what was the gap in the market that you saw, and what is it?
Life insurance, sadly, or financial protection, as I like to call it, still plays the poor second cousin to financial planning, and that's so obvious when your day-to-day interactions, in my case, are with financial planners. In the worst case scenario, you see this subconscious scoping out of a really important need where it's just as clear as the nose on your face. The client that this financial planner is describing to you, when you're saying, look, where are you at with life insurance? Who are you referring to? Because I don't see a lot of it. Oh, no, my clients don't tend to want that. And it's like, sorry, it's not their job to tell you what they don't want. It's your job to actually explain to them that, hey, it's as equally as important. They know they've come to you for a comfortable retirement, and that's great. And financial planners will do that. But it's the thing that's underpinning your ability to save for that comfortable retirement, the income, the revenue, however you generate it, your responsibilities to your family, your mortgage lender, just make it so bloody obvious that this area needs to be tackled. So my quest, I guess, or my desire is to create tomorrow's life insurance specialists, even if it's one advisor at a time. And ultimately, financial planners know they need help. They tell me time and time again, oh, I used to do so much life insurance, or I started working for a bank and we all had to do life insurance, present company included. That was me, definitely. But it's just become so complex. So my inevitable question is, well, what are you doing about it? Oh, look, I've kind of got a relationship with someone, or, if a client really wants it, I'll get involved. It's just not doing what they need to be doing with it. So that's the gap that I'm trying to exploit.
Yeah, let me just kind of double click on one of those concepts about, life insurance or financial protection being the poor, ugly cousin of the financial advice space. Why do you believe that to be the case?
I really think that in some cases, life insurance has been stigmatized by its heritage. And as many financial planners and people would tell you, it's something that you need to buy. But no one knows from the outset that they need this financial protection. They suspect they need it. But I just think the inertia of everything that's happened with respect to regulatory change, all of those well-meaning tweaks to financial advice regulations have just pushed it back further from this, oh, look, isn't that the realm of some life insurance salesman, to, oh, yeah, okay, it's part of financial planning, but it just doesn't seem to be the appropriate training mechanisms from the outset to just bring it into the profession, bring the perception of the average punter into understanding that, hey, this is critically important.
My journey in advice, I did very little life insurance, and I was very hesitant, and I always try and reflect on my time as, because it is the ugly cousin of the financial planning space. Like, investments are more exciting because we can talk to our clients about basically like we've like magically created more money in your bank account through these investments. It's called, compounding interest, that literally money goes into your bank account that you otherwise didn't have because you've invested it. And how kind of exciting is that magic of investments? But life insurance, it is a majority of all clients will pay a bill that they never see a return on. And as advisors, we kind of like, we want to align ourselves with our client's financial journey of going, like, as advisors, I want you to benefit and succeed financially. And having this bill in that line item in your family budget is kind of inherently this difficult positioning. And to be honest, same with advice fees. It is inherently conflicted in terms of going, my desire is to charge you as much as possible to run a profitable business, but as an advisor, in my advisor hat, we've got to reduce those fees as much as possible. And so there is always this difficulty with, fees and insurance. And I think that's why when we're not really seeing claims as young advisors, when I was young, I didn't really see any claims for a long, long time. And that's why I didn't really believe in it. And I moved into life insurance from specializing in it because I saw the business opportunity, and it was purely from a business economics point of view. Everyone's leading the space. Let's come and do it well. And now that I'm specializing in it, now that I see it all day, every day, I preach life insurance now. And it's always young advisors coming in talk about how, older advisors talk about it's a noble profession. It's all this. And it's always just like, well, is it, or are you just trying to do it for the commission? There's always this question that I hear around the traps, and I thought it myself. And do you kind of believe that that's maybe some of the hesitation as well?
Yeah. Look, I don't think consumers have reconciled themselves to commission equation, and doesn't help when you've got consumer groups actively promoting that line whenever there's question is raised around, well, should we be looking at commissions? Immediately they jump on the headlines, they see, oh, you're picking up 60% in year one. Boy, that's an awful lot of my premium that you're taking, not really understanding, not having been through the process themselves, that you've got a team behind you, and you're going to invest collectively anywhere from 12 hours to potentially 20 hours to making that advice sensible and then actually implementing the insurance policies. We just don't do a good job in articulating what it is that we do. And we don't do a good enough job of shouting from the rooftops how we help people. And I'll just add this, Bill. I was so impressed one morning a couple of years ago when my daughter sent me a screenshot. It appeared in her possibly Instagram feed. and it was Sky Wealth Advisors. And I'm like, hey, this is good. This is not the Phil Thompson I knew. He was probably 10 years older than me. This is a new modern looking Phil Thompson who's got a really good message. So you're proof.
Yeah.
And look, congratulations on the release of your financial report this week. Just getting those nice infographics out on who you've helped, how you've grown, and what your big, hairy, audacious goal is. Because you are proof, as are scores around Australia of financial planners who are just doing life insurance, just want to do life insurance. So I want to make it my quest to connect as many of those financial planners who are still sitting on the fence to people like you.
Yeah. And I mean, I think I talk to other life insurance specialists, and I talk to any new advisor coming in, and I almost beg them to specialize in life insurance because it's a great business. It's a great work we do. And it is again, I'm like this older, risky now where I do see it as much more of a in life insurance, getting people to pay this bill that no one wants to pay, because when they claim, no one thinks about the premiums. No one thinks about anything that's happened before once they've got the money in their bank when they're going through this, significant event. And I'm comfortable telling my clients, most of you won't actually need this money. That's literally the point of insurance. Most of you won't need it, but the ones that do, they need it properly. So yeah, I know from my conversation with other riskies, everyone in this space who specializes wants more people in this space. No one's precious about competition. I literally tell every advisor who's coming in, specialize in insurance, do it. And they're like, oh, I'm not sure if I want to do that. I'm like, do it. It's good work. You've got to reconcile personally about, being the ugly cousin, because our egos don't want to be that. We want to, the fancy suits and be, investment gurus. But so let's talk about kind of what it is that you're doing with the life insurance space.
Yeah, look, maybe I'll tell you about the average week. Naturally, I've only been going at this properly since May. So naturally, more than half my time is spent business developing, phone calls, appointments, reaching out to the old networks, just letting them know what I'm up to. So that's the largest component right now of getting a life insurance guy up and running. The nice thing is I've got a small band of loyal retainer clients, and those retainer clients have differing needs. Many of them will approach me through word of mouth saying, hey, I actually have my first claim. I've never done a claim before. Can we just talk about it? And I'll give them 20 minutes of my time. But inevitably, if it's complex or if it's permanent disability, and once I've explained to them that, look, there's a journey here to go through and it can be somewhat daunting. You know what you're talking about. You come highly regarded. Let's get you involved here. But I'd rather not be doing that stuff because there's some really good people out there. Bruno Maraca at AFRM, Trevor Battersby at TPD claims, these guys are proving that financial planners or authorized reps, whatever you want to call them, are the best people to handle your claims. All right. So that's certainly an area that early on I got a lot of traction from. But more recently, I've realized, and we had a chat about this recently, practices have been merging. They've been growing through mergers. And a couple of things come out of those mergers. The first one is that usually one practice has a lot of strength in life insurance and the other one doesn't have a lot of strength in there. But they've all got their own ideas around what their philosophy, what their house view should look like. And homogenizing their house view becomes just part of that integration following the merger of two practices or three practices in one case. Resetting their insurance philosophy is slowly becoming one of the favorite projects of clients who reach out to me and say, look, how can you help us in a more strategic sense? And that will involve typically a couple of sessions, half day. We involve everyone. So the director of first impressions, as I like to call them, the first person that greets you. If you're old school and you have an office and you like people to come see you in your office, we just make sure that everyone understands why having a financial protection strategy in place is important. And inevitably, someone around the board table, when we are doing our workshops, is going to put their hand up and say, I've been touched by cancer. Or, my father died when I was 16 and they'll tell you their devastating story. But equally, you'll also have people around the table to say, oh, we actually changed someone's life at a time when they didn't actually believe there was financially any hope for them. Life insurance philosophy is so important. If you're going to have a number of advisors talking to clients, you need everyone to be consistent in the approach they take. That includes superannuation ownership.
Yeah, I find some of this stuff really interesting. People often will hold two truths in their mind about, I have had a mum, a dad, a sister, a friend who has had cancer, and it's had a really devastating impact on them. And sometimes, especially if they're not believers in insurance as much, they'll also say trauma insurance is kind of a waste of money. And it's really funny that we have this kind of hesitation towards paying premiums, as well as knowing that they've had someone very close to them, and if they've been uninsured, they realize the financial burden. If they've had insurance, then they're like, oh, it was a lifesaver for them. And so I do find it interesting that, with our networks that we've built out to generate leads in our business, I've seen a lot of that, those two points of view. And I guess you'd see that in advice practices, where some advisors would be going hesitant because they don't want to sell the premiums, or maybe they're just not convinced that, of the value of insurance. But then also having lived experiences with people around them. Is that a part of that conversation that you're having about the philosophies, is also getting the advisors who may not be, all in on insurance, to bring them across to going, hey, this is a part of your clients', financial security?
Absolutely. It still surprises me that I will hear of each month financial planner telling me that they believe TPD is a waste of money. And I immediately, I'll correct myself right now. The magnitude of being totally and permanently disabled, right, is we've got to stop using the term TPD with our clients. We've got to say, this is profound. And ultimately, when I say, hey, look, I probably are involved in, I have at least one total and permanent disablement claim on the go at any given time, where I'm lending support to the admin and the financial planning team. And in some cases, the financial planner is asking me into a discussion with the client just so I can get a good feel for what's going on. Look, we've got to get you to that retirement, but ultimately, if you're one of the unlucky 1 in 5, either through an accident, misfortune, or just, hey, look, this is the result of the scans that have come back, and this is what we need to do. 1 in 5 people are going to see that in their working life, and the impact could be, if you're lucky, 3 months. And most people you talk to, and you've got to make it relatable to the client. Most people you talk to will say, look, I will only perhaps last a month at best if my income completely stops, once I've run out of all my options, once my redraw is gone, once my sick pay is gone. And that's really what we need to be focusing.
And Zurich, with their launch of the cost of care 2.0 or whatever they're calling it, they talk about the percentage of people who are retiring early because of ill health for themselves or someone that they're caring for. And that was a real big highlight for me to go, it's not a young insurance is not a young person's game. Like we predominantly, our average client age is like just under 34. So we talk about, well, the cumulative cost of losing your income is really significant. And so that's why it's important to protect all that stuff. But, using that Zurich cost of care stats to say, like, I think it was like 30 or 40% of the individuals are retiring early because of health themselves or someone they care for. Like, so it's not just a young person's need insurance. It is for, older individuals and holistic advisors looking at like these retirement projections. Like we all know that the last 10 years of your working life is where you can really significantly ramp up your retirement savings because of tax advantages and all this jazz. But projecting in, well, if 30% of people are stopping early, then that will lose your last 100K of projected growth on your super balance or whatever that number may be for those clients. So, and again, we all understand we've got to weigh it up against the cost of that insurance and all of these factors. But any holistic advisor who is kind of finding it a little bit difficult to have those conversations, I'd definitely give a shout out to that cost of care paper and have a look at that retiring early statistic.
And, if I could just add one more thing, by adopting a financial protection culture in your practice, and what's triggered me here is you said, hey, look, you might have to stop work early. But I always say there's that intergenerational thing, and we all often think about the children of our clients. And I actually say, look, the intergenerational is critically important, but we need to look up one. We need to look at the up generation as well as the down generation. And whilst I can't take out insurance for, say, my parents, the possibility that I might have to stop what I'm doing to care for my parents if there's a sudden decline, or I can see, hey, there's a decline that's happening here, and I've got to start planning for less income. How do we discuss that with our clients who are still in accumulation phase? Even though we can't put insurance in place, financial planners are in the best position to actually say, look, I'm really glad we've talked about this, because we can have a look at what the status of your parents is right now. Because if they do, or one of them needs to go into a facility, we probably should have a plan B in place for that as well. And that's financial protection.
Yeah, exactly. And so we were talking before we hit record about kind of a lot of your work you're doing is talking to, practices about their in-force management. Some business may have like, $3, $5, $10, $20 million of in-force premiums that is, we're seeing re-rates, be relatively significant over the last 5 years, and cancellation rates, are what it is. So what is some of the work you're doing with some practices with regards to their in-force management?
I call this the segmentation project, part of my work. You make a really good point that we've seen premiums skyrocket, particularly in the step premium space. Inevitably, when you ask a practitioner who has, let's call it an in-force backbook of life insurance clients that might not be that well engaged, so they're an overhang of history, if you like, they'll tell me that the income from that cohort of clients is fairly steady. It doesn't go down. It doesn't really go up. It's steady from year to year. Some of them will actually say, oh, look, that's great income. It helps me pay for school fees. And I say, look, that's wonderful. But here's the thing. If premiums have gone up 50% or more in the last 5 years and your in-force revenue is static, then you're actually heading for a cliff. You are actually losing clients. Clients are calling their insurers and cancelling, and you have disconnected so much from this particular cohort that you don't see it. So segmenting that group of clients to understand their demographic, to understand the ones that are, as a client, we're never going to fit your ideal client. You've got two things you can do. With those that are paying, say, $8,000 of premium a year and might be in their late 30s or older, why wouldn't you engage with them? Why wouldn't you try and get ahead of the curve and say, all right, here is this group of clients that clearly have capacity to pay. They haven't contacted me. They haven't cancelled their cover. What if we reach out to them ahead of their next policy anniversary to tell them, hey, these will be your sums insured at your next policy anniversary. And B, you may actually, having not been reviewed for as long as it's been since you put your cover in place, you may actually have too much cover. So leading with that sort of approach to say, look, it's time to review this. So we can, as you pointed out in a recent post, Phil, remove loadings that might not be relevant anymore, remove pastime loadings because you're no longer skydiving. Save you some money in some way, shape or form, but importantly, cost relevant to you. So that's part A. There's the low-hanging fruit of potential new clients. And the second part of that is, for those that you're never going to work with, there are financial planning practices out there like yours, Bill, who have appetite to take the servicing of those clients, to buy it from you. And they're prepared to do it in any number of ways. They'll say, hey, look, if you're engaged with some of these clients, that's great. We don't want to do their accumulation. So let's put that in place. If anything comes up with their insurance they need to claim, we'll handle that. But importantly, bring us into the review. So yeah.
And so in terms of your recommendation when you're going into a firm, it's a matter of, hey, do you have a propensity or a desire to service these clients full stop? If the answer is no, then are you comfortable with just letting it sit and run off? Because it will run off.
Yes.
And there is a moral question of should you do that? But we'll leave that to the side. And then the other thing is, are you happy for it to run off? Or do you want to look at packaging up and selling it off is kind of another way, or do a some way partnership in, somewhere in between maybe. Is that kind of the first step in terms of understanding the business's kind of desire and their growth plans and what their plans are?
Absolutely.
And what are you seeing is the normal kind of like desire for most of the businesses that you're looking at are they looking at partnering? Are they looking at selling? Are they looking at getting into doing a bit more within their practice?
You know what they all have in common? They don't know what they want to do.
Yeah.
So that's usually why they've got me involved. And all of the things you've just mentioned, partnering up, that to me, that's nirvana. That should just be the norm. Accumulation financial planners, people who want to specialize in that area, people who don't want or can't afford to resource or whatever it is, they should just naturally have a relationship, a formalized relationship with someone like you.
And I think, again, there could be confirmation bias. We're seeing a lot of it because that's kind of the work we're doing. But I do feel like just broadly within the financial advice space, there is a lot of need for financial advice, and the level of advisors in the market is bottomed out, I guess. I'm seeing a trend in advice where people are very willing to partner up, very willing to outsource, very willing to make introductions outside of their own business. Historically, I haven't seen that in my time in advice. A lot of people historically were just trying to capture every dollar spent in financial services. How do we build it all into our business? And now it's like, hey, we want to nail this one area and we'll partner with other businesses.
Yeah. And look, some larger licensees, so, the dealer groups that we all know and love that are really large, have north of 200 advisors. Some of them have some really great programs in place. One of the best things I do each month, once a month, with one of those is a mentoring forum for 1 hour. We bring together, usually 30 people turn up. We had 60 at one point. They will turn up. We inevitably get 2 to 6 financial practitioners that actually are, in my opinion, very good at life insurance. And everyone who turns up brings something from the field to the table. They'll either bring, I'm having some difficulty following the divorce of a client. They're in an SMSF and there's insurance in the SMSF. And one of the family court orders is that her cover, to be vanilla, has to come out of the SMSF and he has to keep paying for it. Right? And, as consumers, we would assume that that's going to be straightforward. But for various reasons, particularly with a policy that's no longer on sale, as we like to say, that's easier said than done. So the collective experience of those 20 individuals in that forum, either pointing you to someone in that life insurance company who could probably help, or just saying, no, I've had the same issue. Let me tell you what you need to do, is priceless. They do want to learn. They do want to service their clients. That group knows that they need to do something. Inevitably, they haven't yet accepted that it's probably time to partner up. And that's what we're trying to do.
Yeah, that's the great opportunity within the licensee space. So we went self-licensed, but within the licensee space is having that environment where you can connect with, businesses. Like at Sky, we're fortunate we are big enough where we see a lot of these challenges. And so we know we've got all these like frameworks in our business, like what does allow a cancel and replace within self-managed super fund, what product, all of these things, because of size and scale and experience that we have. But, if you're got, 50 clients and this is very once off, you haven't seen it, can we cancel and replace? Can we not? Because most of our clients we're not really doing that work for. Having that kind of environment, or having someone like yourself who just pick up the phone and go, hey, what can we do? What can't we do? Is super helpful. And so I want to kind of touch on just a quick tip in terms of segmenting. You said, hey, go and segment your clients, see where, I guess A, B, C clients, if we want to use that terminology. Are there any tools that you use to segment the clients?
I'll give a shout out to a group called CDM.
Yeah. If you weren't going to shout them out, I was going to, because we use that internally as well.
Yeah. Look, right now, that is the quickest way to get a handle on a dashboard on what your insurance clients look like, the profile. In some cases, we're prevented from using it by some licensees. We're working on that. Those guys are serious about what they do. They've got their CPS 234 audit. I think I'm pretty sure next time I speak to them, they'll say, yeah, we've now got our ISO 27001. So as far as data integrity and safety goes, privacy, they've ticked that off. So look, it's no easy feat to get that data into a standardized format, simply because we don't have a consumer data right, as we do in banking. So right now, it's the 21st century. We're nearly a quarter of the way through it. And, our friends, the life insurers, bless them, have yet to get together and say, let's get a data standard in play, which would just help nub it.
Yeah, exactly. And just touching on that as a solution, when we've looked at taking on some client bases, we've actually utilized CDMs to go, actually, let's get your client's data, because then it's just super easy for us to understand the average client age and what the demographic looks like. Like, it takes us 10 minutes to kind of do that rough due diligence just to get a rough understanding. And so any practices out there who are looking at, whether they sell their client base or their risk insurance, CDM, either you can use it or whoever's you're looking at partnering to acquire those clients, if they can use that as well. And it just helps that due diligence process as well. So it is a great tool. And I know you're not saying this, but I will say to any licensee that doesn't allow it, just pull your heads in and just, it's makes the advisor's jobs much easier. But I know that's definitely not from you. Now, the last point I wanted to touch on is, I guess one of my bugbears, and I'm about to just go ballistic at insurers, about upfront discounting and durational discounting. Now, this is a bugbear for me. And the reason why it's a bugbear is because it's often not disclosed to the advisors. And I'm glad you're going to be here for another 30 minutes for my, my soapbox rant. But basically, insurers are discounting the premiums in year one and it comes off over 10 years. Sometimes that's not actually disclosed in the quoting software. You just got to know that it's the case. And so even our business, we specialize, got over 2,000 clients. We're, setting up 1,200 policies a year. We had to actively go and try and find out this research. And there are some insurers in the market who won't even tell me what their durational discount is. They'll say they're doing it, but they won't actually disclose their numbers. So it's a massive bugbear for me. And that's where I think like this specialization or not is really important, especially in today's day and age with these shenanigans that are going on with insurers, where they are doing upfronts. Because you may look at rewriting a policy, and let's assume there's no exclusions coming on or coming off, standard rates, which no one's seen ever. But standard rates are standard rates, and we're comparing on pricing. These days, it's so difficult to know, is that actually the pricing that includes a durational discount, where it's 25% off in year one or 27.5% off in year one and coming off? Or is that the base rate pricing? And so I guess, is that a part of your conversation with these practices about going, hey, understand what's happening in a pricing space to know that you're either got to be in or out?
Yeah. Look, feel like I echo your frustration with this tool, if you like, or this approach that seems to have almost caught up with every branded insurance policy currently on sale. It's the fastest way to alienate a client that I can think of. Down the track, they're just looking at this cost escalating, and the financial planner is wondering why this is happening to the extent that it is. One thing I can say to most people is, look, take a step premium, and once you're over 50, the sum insured doesn't change. It'll double roughly every 5 years. A couple of examples I've been shown recently are seeing that sort of increase for people much younger than 50. Someone put this really nicely to me not that long ago. They just said the industry just has to get out of its own way, because all it's doing is it's just feeding this never-ending cycle of frustration, where we should, in a perfect world, be going back to the same insurer and saying, look, we're going to make some adjustments to this cover. And ultimately, it makes more sense to actually go to a competitor.
Yeah, and I mean, it is an interesting space, and just a few shout outs. I know Ben Donald's doing a lot of work trying to collectively get a whole bunch of bigger insurance, businesses together to try and influence insurers. And
bless him.
And we need to also, it's just a really interesting thing. As advisors, we need to not just get our patch and go, why are they doing this to us? We need to think about the industry, because if you talk to insurers, they're all saying, well, that's where inflows goes. It goes to upfront discounters. So we all have to play this game. And so I empathize with all sides. And this is where I think we need to collectively take a global view of the industry, of going, upfront discounting is bad for the insurers, the clients, the advisors. But, advisors have to flow towards upfront discounting, because ASIC will tell me off if I don't choose it, or there is a fear that I'll get told off by ASIC. Then the insurers are saying, well, we have to play the game. If someone's upfront discounting, then we have to join that, we have to join it because we don't get inflows. And then so there's this kind of circle where we all need to take responsibility. My personal view is the top 10 licensees in the country need to just ban insurers off their APL if they're discounting above 20%. You just need to be off.
Yeah, look,
and that'll bring it down. And then when everyone comes under 20%.
Radical idea. I think you're right. Something needs to be done. To me, you've captured the essence of professionalism by saying someone like yourself, someone like Ben Donald at ABFS, just writing life insurance, just implementing life insurance. The rod that the insurers create potentially for you as practitioners is that someone can just make this very binary. They can say, oh, look, aren't you lucky you were able to recommend replacement, right? And you've recommended replacement for all the right reasons, right? No regulator's going to call you out. You've done it properly. Let's just say you've passed muster, your file's been foamed over, but here are the optics to a consumer or to a consumer group. They're going to say, oh, you have more opportunities to earn new business commission, and they'll put a full stop then. There'll be no further explanation about that. And none of it just doesn't help our cause. And you guys are stepping up and saying, can we just stop?
Yeah.
We really need to stop.
And I mean, this is the thing, just to pull back the curtain, in my business at Sky, we've made a very conscious decision that we place policies where they start and we increase or decrease where they are. And we've had big conversations with majority of the insurers in the market to go, let's have it with their actuarial team and their pricing team to go, are we the idiots in the room for doing this strategy? Because it's good for consumers to keep their insurance long-term. It's good for insurers to keep their insurance long-term. It's good for us it's actually not good for us because it's harder to increase or decrease than to rewrite, but I'll leave that aside. It's good for the insurers and good for the consumers, and therefore long-term it'll be good for us. But I'm literally thinking, am I the idiot in the room doing this strategy? Because with these upfront discounting shenanigans and, am I actually placing my client in a worse position because of this? And we had these conversations with insurers. Are we actually putting our clients in a worse position? Because I understand the optics, and your conversation about the optics is really important. But then, realistically, it probably is better for our clients to rewrite the policies, assuming there's no added exclusions and complexities there. It is because of the pricing mechanisms that's going on. It's a really interesting thing that if you're dabbling in insurance, I've gone real deep into kind of specialization, and this is why I'm a big believer in specialization and not dabbling, because you then get to make these decisions that you think is collectively better for the group and not just individually, well, I can get a better price on this one policy. Because at the moment you can, but it's actually really unsustainable. And it's just shenanigans. I'm so fed up with these shenanigans from insurers, but what can I do? I'm just a small fish in a big pond.
Well, yeah, but you would think that the recent phenomenon in the lapse rate, the increase in lapse rates, which is kind of heading towards 20%, and it should be, closer to 11 or 12, you'd think that would be enough to cause the industry as a whole to say, well, that's not where we need. We shouldn't be there. You don't need 1 in 5 leaving. It's just, it doesn't make.
And again, my strategy is to try and be the biggest, baddest and scariest advice firm in the country. So then when we bully insurers to do the right thing, then they actually listen to us. And then I can just try and get other bullies to join me in my cause and say, literally, let's play the APL game. If you're discounting above 10%, you're off everyone's APL. That will solve the problem tomorrow. But there is difficulties in doing that, and can we do that or can we not? I'm sure legal teams will freak out by bullying insurers to do the right thing, but fundamentally it's in the best interest of everyone in the marketplace to do it. But yeah, I've gone on my big rant, and it's literally just this massive bugbear of mine. We've just done a whole bunch of internal research and just noticing some other shenanigans from one insurer that I'll share in the Facebook group potentially, that I can see other insurers following the exact same thing, and it's just pricing shenanigans, and it just needs to stop. And yeah, I'll finish. I'm sure I'll do an episode like just me on my own ranting for 3.5 hours. But let's move on from that conversation, and just how do people get in touch with you? And I guess not just how do we get in touch with you, we can all find you on LinkedIn, but like what are kind of the main causes that will mean, like what are the main problems people are having today that they should then reach out to you for?
Less the practitioners who are less experienced but really want to have a crack. And I think everyone, regardless of where they finish up saying, oh, look, we're going to outsource this or we're going to do it in-house, they'll usually approach me because there's been an implementation nightmare. So that's quite common. I don't have capacity to service 500 advisors. Potentially one of the licensees I have brings that to the table. And trust me, that group keeps me relatively busy with what I call escalations. So look, I just maintain my modest LinkedIn presence and post whenever I can and make it very easy for people to catch up with me. But inevitably, it's a combination of doing that and word of mouth.
Yeah.
So someone's had an experience and they've just gone, oh, there's the life insurance guy, or there's this insurance guy, or that insurance guy that leads them to my door. So whether that's, you've already talked about the divorce, cancel and replace scenario, the implementation gone horribly wrong. Oh, look, here's actually a good one that comes up probably more than you think. Retrospective underwriting. So during the course of a review, we're making changes to increase cover, and the client suddenly answers yes to a question 5 years ago they answered no to. And when you ask them the time frame, it predates the initial implementation. So advisors get terrified in that situation, and often I'll just say, look, the first thing we need to do is calm down and come clean. Right? It's good that you've got this out of your client. We need to go to the insurer and disclose that immediately. And trust me, my experience has proven that the water under the bridge, that passage of time since that initial implementation, more often than not leads to a better outcome than what you would have gotten if you'd actually disclosed it at the start. So a little bit of misfortune can actually play well into your hand. The one thing you do not do is sweep under the carpet. Having discovered that as a practitioner, you'll be held responsible if you said, "Oh, let's not tell anyone."
Yeah, that's right. And there is, interesting, requirements about best interest. Like, do we have a obligation to tell our clients to disclose that further? Is that actually in the best interest of the client? There is these conversations that advisors will reasonably have, and not in a way of protecting our own interests, but actually what is our legal obligation? Like, do we decide not to work with the client if they choose not to disclose this? Like, is that reasonable? So these are all questions we've definitely faced in our business ourselves. Like these questions around these additional disclosures and requirements and stuff. And it is very interesting. And if you're not doing it all the time, or if you do have a question, definitely reach out to Peter. It's super important in the insurance space because it is so high risk. People kind of think it's whatever, it doesn't matter. But if your client's missing out on a $10,000 per month income protection claim because of a non-disclosure or some issue, and they can pin that on you, that's a much bigger risk than making a mistake with an investment allocation. So it's definitely worthwhile if you are facing any of those problems, definitely reach out to yourself.
Oh, there's actually one interesting one that I had. One advisor reached out to me and said, Pete, you are the best after sales service I never paid for. And I thought, where's this going? Right. Now that I'm the life insurance guy, he knows I am. Where's this going? And he said, look, I just want to workshop a client with you. And I said, mate, let's just do it now on the phone. and inevitably he was going to cancel an income protection policy. Agreed, endorsed, right? Because the client's partner was earning north of 400,000. Hey, we all wish, but the client themselves was doing odd jobs and earning about 50K a year. Was in effect kept, if you like. And my only question to John, the advisor in this case, was, well, John, here's the thing. If the 400K partner loves their work and loves what they do, and they're defined by it, many of us are defined by our work, and the client had a stroke, would she stop her career permanently to look after, or would you not say that $8,000 a month that's guaranteed and endorsed on this very expensive pre-APRA intervention policy would actually go a long way to paying for care at home?
And and it's a great example why, I mean, it's just, I'm such a big believer in specialization, because I had a client who cancelled their policy straight to the insurer, and we reach out to them and say, hey, I just want to be aware that, do you have any questions, or is there anything, is there a reason why? And then the client came back to me and said, oh, we're working with another advisor because they got us a cheaper policy, and I'm really disappointed that, you guys that I'm paying for these policies are much more expensive. I'm just like, this is an agreed value pre-APRA changes, and this client had happened 6 months ago. And I'm thinking, what advisor did that? Like that is just a high risk
one.
Yeah, and again, who cares? The clients can work anywhere they want. That's fine. Like, I'm not worried about us losing a client. It's just about just go, oh, that's an advisor who may be new, may not understand what happens pre-2021. We ask our associates, what happened pre-2021? What is the difference? They're like, well, what's pre-2021? What are we talking about? So it's like, do we have to educate our associates in this? And so I just fear for anyone dabbling, because the premium differential can be massive. Why wouldn't I recommend that they move to an income protection policy? And sometimes it's legitimate.
Will they see the premium first?
Yeah, sometimes it's reasonable to move, and that's okay. But as long as we're all aware and it's all disclosed and you've tied your bow up perfectly in your advice document, so it's definitely, as I said, I think having a resource in the industry is so important. If you are dabbling, just to touch base. So I think if you do need any help in this space, you can call me up, but I'm not going to answer you. I've got no time. I've got to run my own business. And so that's why having a resource like yourself is super important. So thanks very much. And I do have 2 questions to finish off. When do you get a chance to do your emails?
I'm trying to be really disciplined. So in the morning, and I have to put a time stop on that. And then in the afternoon, now that I'm self-employed, it's usually after 5.
Yeah. And what's one interesting hobby that you have?
Oh God. Okay. Well, you see some artwork behind me. Look, I'm unusual because I actually like to don a crash helmet some weekends and drive my car furiously around a racetrack.
Yeah, right.
And it's just the car that I drive to work.
Whereabouts?
Well, more recently it was at a hill climb, not called a circuit, a hill climb track, because they don't go around. A place called Rob Roy near Sugarloaf Dam, Christmas Hills. Sandown is not unusual, and Phillip Island, 2 of the circuits that I like to do. And one day I'll get to Winton near Wangaratta up north.
Good. Next time you go out, send me a text. I'll come. I'll be in the passenger seat, just like holding on, freaking out. So that'll be fun.
You hit me up. There's a date coming up in November where you're allowed passengers.
Oh yeah, done. I'm in.
Usually you're not allowed passengers.
Oh, I'll just go in the boot and all know. Awesome. Thank you, Peter.
Trust me, the scrutiny is brutal.
Yeah. I appreciate you coming on, and thank you very much for your time.
Thanks a lot, Phil. Appreciate it too. Good on you. Love the work you're doing.
Thanks, mate.
If you've enjoyed this episode and you think someone else will get value out of it, I'd love it if you could forward it on to them. And as always, we can continue the conversation in the My Risk Advisor Facebook group. All you need to do, open up Facebook and search My Risk Advisor, and I'll see you in there.